My name's Packy McCormick. I write a newsletter called Not Boring and run a fund called Multicoin Capital. Woo! Thank you. And I'm here today with two guys who need no introduction. We have Kyle and Tushar from Multicoin Capital. Today we're just going to do a pretty casual Q&A, learn a little bit about the fund, and learn a little bit about just how they're thinking about the ecosystem and how it's evolving and where everything's going. So to kick it off, we're going to start with a really basic question, which is, can you share your personal backgrounds and how you linked up and started Multicoin?
You want to go first?
Yeah, I'll take it. So I grew up in Austin, but went to NYU. And Tushar and I met freshman year at NYU. I don't think either of us remember where we actually met, but somewhere in NYU freshman class sometime. I think we started getting a little closer during our sophomore year. And we were both, this is like 2010 or so. iPhone was like the hottest thing in the world. There was a new social app launching every other day. And we loved TechCrunch. I remember we were always sharing TechCrunch articles talking about the tech startups. After college, we both had the startup bug. Well, I'll tell my story. I launched a company called Pristine in May of 2013. And we built software for Google Glass, those funny glasses, for surgeons. Ended up raising some venture, got to a couple million in revenue, 25, 30 employees, and then Google killed Google Glass, which was a problem for the business, as you might imagine. I learned what platform risk meant in a very real way from that one. So after that happened, pivoted the company, and the company was ultimately acquired in a very small little outcome. In 2016, I had to find something new to do with myself. And in March or so of 16, I discovered this thing called Ethereum. I'd heard of Bitcoin, but wasn't really interested in Bitcoin. And Ethereum kind of pulled me into crypto. I remember telling Tushar about the white paper, and I was like, this thing is pretty cool. Over the course of 2016, started reading and learning and investing in the space. By spring of 2017, I had developed a full-time internet hobby, was still unemployed, and I was having fun. At that point, still pretty quietly on Reddit and Twitter, but engaging. And in May of 17, we made the decision to launch Multicoin.
I have a similar story to Kyle's, but I grew up in New York, and like he mentioned, we met at NYU. I studied finance and political science, but was really passionate about technology. Decided not to go the standard route out of NYU Stern, and it didn't go banking. Ended up actually moving to Austin to work with Kyle at his dad's company for a year. But after that, we left, and we both started our entrepreneurial journeys. Kyle started Pristine at the same time that I started a company called ePatient Finder, which was working to decentralize clinical trials. We didn't call it that back then, but now looking back, like that's what we were doing. We were helping physicians run clinical trials at their regular offices rather than at specialized research institutions. That went fairly well, but I heard about this thing called Bitcoin in 2013. I bought a couple to figure out what it was. It was just two, literally a couple. Wish I'd bought more back then, but I couldn't do anything with it. So I just let it sit there and said, I'll come back once this technology is more useful. And then in 2016, Kyle showed me the Ethereum white paper, started to get a lot more excited because what I saw was the ability to now coordinate human economic activity in a brand new way. So went down the rabbit hole, and by 2017 was just obsessed, talking to people all the time, thinking about how will this technology evolve, how will this change the world, and had to be doing it full-time professionally.
Yeah, I also found Bitcoin in 2013, bought 38 of them, thought it was useless, and sold all 38 of them a month and a half later. So that was lesson learned, never sell. So obviously, we're here in this beautiful big ballroom. There's a big team. How do you think about building out the investment team and the infrastructure at Multicoin?
It's an interesting question. What we really look for investment team members is the ability to form theses and really critically reason about how this technology will develop in uncharted waters, right? Because everything is changing so fast. It's changing faster than it ever has before. And it's so easy to be distracted. It's so easy to look at the shiny new thing. And so really what we try to focus on for investment team members is, can you critically reason about a thesis? And we also really try to prioritize people who disagree with us. For example, our application process, which by the way, we're hiring for 2 new analysts right now, is please write something, a thesis, and if you disagree with us and convince us that we were wrong, that's major plus points. Because we want to have a culture of disagreement. If you always agree, then like you're not really adding much value.
Beyond that, the thing we really prioritize is just individual autonomy. Tushar and I don't want to tell people what to do, and we don't really tell people what to do. Everyone understands the generally shared objectives and vision, and people make shit happen. And they need help with something, they call the relevant person, and they make it happen. But we are like we don't even have like a shared task system internally because just everyone knows what they need to do and they get it done. And I love working with a team that has just like everyone functions very autonomously and things get done and they don't really fall through the cracks.
How do you balance being thesis-driven in a space that's moving as fast as this is? When do you know how to change your mind and when it's time to change your mind, and how do you think through that?
I'll start an example of when you shouldn't change your mind, and then we'll try and pick one when, well, actually, it's kind of a little bit of both. I got into crypto in 2016 and was very drawn to Ethereum. Ethereum, by a year and a half later, it's like, fall of 17, we're in the peak of kind of bull market mode. And I realized that the scaling roadmap at this point had already changed once or twice. And by early 18, it was changing a third and a fourth time. And I was getting pretty frustrated. I was just like, guys, why can't we stick to a plan, communicate it, then have put a public deadline and a public roadmap, and that wasn't happening, and I grew pretty frustrated. And so at some point in spring of 18, we started to say, hey, are there alternative teams who are going to think about building and executing and scaling in a different way? And we very publicly and famously made a big bet on EOS in early 2018, and we ended up being very wrong on that one. They did have an alternative approach to scaling. There was designs in the system that were problematic in terms of the resource allocation model and some other things. But the team also just didn't execute well. What people have been telling us since then is, why would you bet on Solana? You were wrong about EOS. Isn't this the exact same thesis? And I think what was very important for us was recognizing you can be right about the thesis, pick the wrong horse, but you have to understand why the horse you picked was the wrong one. And really being able to balance the understanding of having conviction in the thesis while also recognizing why something was wrong and not just giving up on the concept entirely. There were plenty of examples in history where you could have been bullish mobile phones and there was 10 startups in the early 2000s that launched trying to build something that looked like an iPhone. And you could have just given up on that and not bought Apple stock in 2008, right? And so being convicted in a thesis and appreciating why you were wrong and not just giving up entirely. I don't know what the science is other than until your core thesis is disproven, don't give up on it.
Yeah, I would add something to that. Like, when I think about discipline and staying focused on theses, I think, well, one, when you form the thesis, like, what do you actually know? Like, what do you actually really, really believe? And you have to form conviction around it. And then update it if you have new information that changes that thesis. You have to be flexible in that way, but don't change your mind because other people disagree with you. Like, what other people think is like irrelevant. Like, don't include that, because the only way to make exceptional returns is to be contrarian and be right? So you really have to stick to your thesis if you have conviction, and be willing to incorporate new information, but not necessarily like change it based on social consensus. On Kyle's EOS point, like, if you judge a VC by the things that go to zero, like, that's the wrong way to judge a VC.
Totally. So there's one that's near and dear to my heart that I would imagine ties into kind of forming a thesis and getting buy-in at the firm, which is writing. There's obviously a very strong writing culture at Multicoin. The blog is actually good, which you can't say for, I think, most VC funds, and I learned a lot reading it. Why is writing important, and how does that kind of become a part of the day-to-day at Multicoin?
Yeah, I think Kyle really started off the culture of writing. I remember when we were roommates, once he told me his New Year's resolution was to write 3 blog posts a week. And I was like, you're crazy. That's not going to happen. But he did it. He wrote 3 blog posts a week. And the thing with writing is it forces you to be a lot more critical of your thought processes. It forces you to examine the holes in those thought processes, especially when you publish your writing in an adversarial environment such as crypto or crypto Twitter, and people like to poke holes. Like, that is enormously valuable because you learn from that. You learn from that experience, and it forces you to fill in all the gaps. The other thing that we really like about writing is that it creates a better environment for an idea meritocracy in a flat organization. For example, when we have investment committee meetings, we start out silently reviewing memos and putting comments back and forth in Google Docs with each other, because then everyone can talk at the same time, right? And anyone can write anything and be coherent about it and bring up a point. Whereas if you have a verbal investment committee meeting, like, well, you can just talk more than the other person and filibuster them effectively, and that can drive decision making. Or someone in a power position can just, take over the conversation. And so we find that doing as much for thinking and writing as possible is enormously valuable.
The other thing I would add is that writing scales extremely well. This is more of an external thing than an internal thing, but I think people underappreciate the importance of being able to seed ideas in other people's minds. We spend most of our time as a firm in one-on-one conversations, either with LPs or with entrepreneurs, and obviously the total amount of information exchange between people is limited based on 1 or 2 or 3 people on a phone call. But when you write something, you can write once, and because of the internet, you can replicate it 1 billion times, and 1 billion people can read it. And it's extremely unintuitive that you can take 1 billion shots on goal by writing something one time. You write it once, people start retweeting it gets shared, people email it, whatever. And it's amazing how when you put something out there for the people that it would resonate with, it's actually incredible how quickly content finds its way to those people, even if they had no previous idea that you existed. Once you even start getting even a little bit of a network out there, you write something, they read it, they forward it to someone, that gets forwarded, and the chain of forwarding across both social media and email is extremely effective. Whenever we publish blog posts now, we almost always get responses back from people we couldn't have imagined. And I think it's a real superpower to leverage one-to-many communications in that way. And once we realized that, we leaned into it, even harder and more than we did previously.
I want to dig into one piece of what you talked about there, which is writing as a part of the decision-making process. If you zoom out, what is the decision-making process for you guys?
So we're conviction-driven rather than consensus-driven. Everyone does not need to agree on the investment team for us to pull the trigger. There's really 2 levels of decision-making. There's like, are you going to do it? And then there's sizing. And like both of those things matter, and they're independent decisions, really. The decision-making process is we continue debating the thesis first. And there needs to be a clear, coherent thesis. Like, we're not going to do a deal just because it's exciting and hot and like everyone wants to do the deal. We have to truly understand, what are we underwriting? What is the risk that we're underwriting? What are the design decisions that they're making here? And then from there, build the conviction to actually like do the investment. And then if there's a sizing discussion, if it's a seed stage round and you're leading the round or something, like there's not much of a sizing discussion to happen. But if it's something later stage, then there's a question of how big is the market, and how sure is value capture, and what is the valuation that you're paying, and like those things contribute to sizing.
I think the things I would add is just, we are actually relatively templatized in our actual investment memos. We have literally a template people copy and go from there. And there's like 7 or 8 sections or something, but the 3 that are probably the most important are thesis, which is the first one, and then what assumptions are we making, and then how does this thing compound? I think everyone on the investment team gets very frustrated with me because they'll have 4 things listed on the compounding section, and I will highlight each of them, and I will say, this is not compounding. This is just a fact, but it is not a nature of compounding. But coming back to Tushar's original point about poking holes in your thought process, it's much easier to do that in writing than it is in a verbal context. And forcing ourselves to be disciplined and say, you always have to answer these really key questions. You're going to do it in a written format. Helps us avoid kind of unforced errors.
So on the other side of that, obviously one of the unique things about investing in crypto is that at some point you're going to have liquid tokens. At some point the lockup will expire, and that happens a lot more quickly than it does in traditional venture. How do you think about when to sell and how much, and make those decisions internally?
It's a good question. It's different depending on different funds, right? So let me talk about the hedge fund. which is the flagship vehicle, right? So in the hedge fund, it's really a best ideas fund. And so our intention is to have our best ideas, something like 8 to 12 positions, drive the vast, vast majority of returns, 95, 99% of returns. And so really there's 3 ways that something gets sold in the hedge fund. Reason number 1 that something gets sold in the hedge fund is because the thesis has played out or been appropriately valued by the market. That's fairly intuitive. Reason number 2 that something gets sold is the thesis has been invalidated. We got some new information and we no longer believe in the thing. Or reason number 3 is we like something else better. And that's it. Like those are the only 3 reasons to sell something in the hedge fund, because it's a permanent capital vehicle, like it lasts forever, it's open-ended, there's no fixed time duration on there, though we're usually looking about 2 years ahead is like how far we can think. In the venture fund, it's a little bit different. With the venture fund, our methodology is if we continue to believe in the asset, but it's liquid, we'll start distributing it in kind to our LPs, and we'll hold our carry in kind as well. And if we no longer believe in it because of any of those reasons, those 3 same reasons that I mentioned about the hedge fund, we'll sell it and distribute cash back. So pretty standardized framework there on how we deal with that stuff.
I think the other comment I would make just generally is we really only want to invest in things that, at least at the time of entry, we believe it's something we can hold for 10 years. It should be a thesis that should continue to compound for a very long period of time. Right, like the easiest way to make money in the last 20 years was just to go long the internet. And like there was no one name to pick, but if you just pick the basket of like 10-ish internet names from 20 years ago, like that was a phenomenal, one of the best performing hedge funds in the last 20 years. Like, that's kind of sort of what Tiger did in a lot of ways. And we look at crypto in kind of a similar vein. We want to pick things we like, and then we want to hold them forever. And if crypto ends up mattering in the way we think it will, then just let those things compound, and compounding produces really exceptional results in the long run.
Yeah, I want to add something to that, actually, because that is a really good point. Like, I think that almost all of the returns in investing really come on the tails, the tails of the distribution, right? So we really don't try to optimize for anything else. Like, what we want to optimize for is like own the thing that is going to be on the tails, that's going to deliver those exceptional returns, and don't sell it too early, and let it compound. Let the thesis actually play out. I would say, like, to go back to like Web 2 world, like the mobile thesis is just now, like you can say like it's really played out. Like almost everyone in the world has a smartphone, and it's just now like getting to the point where that thesis is like probably mature now, right? So like these things just take time, and they can compound at really exceptional rates for an extended period of time.
One other thing I want to say on that, I remember in 2013, right as I launched Pristine, there was a TechCrunch article written, and it said people were talking about the next hot thing, and Google had just launched Glass or was launching it, and there was certainly a lot of hype around it at that time. And I don't remember which VC it was, but some VC wrote an op-ed on TechCrunch, and they said, guys, the most underhyped tech trend in technology is mobile, and they just couldn't be more right. The iPhone at this point was 6 years old. The iPhone was 2007. App Store was 2008. So it was 6 years old, and he was saying, like, guys, ignore all these other things, even the iPad and Glass and VR, just and like that was absolutely the right thing to believe. And I look at crypto today, people are like, is it too late? And I'm like, what are you talking about? Like, I'm not, no.
How do you think about that balance then when, obviously there's a lot of time left to compound and a lot of room for crypto to grow, but market caps, or at least, fully diluted value of a lot of the protocols and projects that you invest in get very big very fast. How do you think, do you have a price target when you kind of go into an investment, or how do you think about it when maybe the thesis hasn't fully played out, but the market cap is reflecting something that has?
Yeah, this is one so saying the rules of the game has changed is, in the history of financial markets, usually been a stupid thing to say because the rules inevitably come back to reality. But there is actually a couple of structural changes in this market that are just very clear and obvious that differ from traditional markets. The most important of which is just the composition of the people in them. If you are the CEO of some random tech company, $10 billion, $20 million, Twilio, Cloudflare, whatever, something, it's like important infrastructure, but is not sexy or consumer facing. I suspect, you can pick the country of Argentina or the country of Vietnam or the country of the Philippines or whatever, and like absent, a handful of very wealthy families in those countries, you have 0 retail holders from most of the countries in the world, right? Probably 80% of the world's population doesn't own an equity, or at least an individual name, other than maybe like Apple and Google or something. And you look in crypto, and a lot of people, they own no individual equities, but they own a lot of crypto. You probably see that with your Uber drivers, but this is even more true around the world. And so the composition of people who are getting exposed to these capital markets and participating in them is just vastly different. If your net worth is $2,000 and wherever you are, you actually can't buy Apple in most countries around the world. If you're wealthy enough, you can get connected to some banks and such and buy Apple stock, but you just can't do that with $2,000. But you can go buy some HNT, you can buy a hotspot miner, you can put it in your window, you can tell your friends about it. No, seriously, and you can create a TikTok video and publish a TikTok video and create your own follow. It's incredible to look at the stories of all these random people doing this stuff. And those people are the ones who are driving a lot of action in this market. And if you think about historically who were the marginal buyers and sellers in financial markets, it was obviously not these people. And these people are today most of the market. We've just never had a world where 8 billion people were looking at credibly buying and selling these names and having access to them. Historically, for most US and European equities, there was call it a couple 100 million people tops, realistically, who had the money and access to them. And so the market structure has changed. I don't know what that means in the long run for valuations, but mechanically, it's just very clearly different. And we're always trying to be cognizant of that as we think about what we put on and what we don't.
Yeah, I think we're so early still. I think we're incredibly early. All global crypto market cap is what, 2.5 trillion-ish? Global public equity market cap is 120 trillion. That's not even including private companies or all of the debt capital markets, which are also enormous. And I think crypto capital markets will grow to become comparable in size. I can't say a number. It's just going to take a long time, and it's going to compound for a while. But I do believe that crypto capital markets will replace US equities markets as the deepest and most liquid markets in the world because they're global.
When you think about the point on anybody having access to the crypto markets and people getting involved all over the world at any age, how does that play into how you recruit for the investment team and where you pull from and how you think about who would make a good investor?
I think there's a lot that needs to be unlearned if you're a traditional investor trying to invest in crypto. Because there's just these neural connections in your head. It's like muscle memory of oh, where's the IP? Where's the gate that I can throw up with a toll house and charge you a toll? And that just doesn't work in crypto. That's not how it works, right? You have to think about business models that work in an open source, permissionless world, and anyone can copy your code. There's no IP, there's no gates. You have to think about different ways to monetize, different ways to capture value. And so when we have people come and join that have traditional investing experience, they have to spend 6 months unlearning all of it before they can really start being productive and really becoming crypto native. Or you find really sharp people who have the skill set to be investors, but haven't learned all those bad habits from traditional finance and can actually reason about all of this stuff from first principles from day one. And that can make people really, really exceptional.
A comment I would add is, because our job application process is write an essay and send it to us, I literally don't even read the name of the person. When I get an email, I just click the PDF or the Google Doc, I start reading it, and I'm just judging them on that. I don't care where it came from. That obviously has some bias for people who speak English as their primary language, but other than that, I want to ignore as much bias as possible, and not reading the name of the person is actually a great way to do that.
Yeah, I have no idea where our investment team employees went to school, or if they did. None.
When you talk about unlearning things that traditional funds have done, obviously I think more and more funds are moving to kind of the hedge fund, venture fund model these days, but how do you think about how those two funds work together, what you allocate to which, and what you invest in out of which ones of the funds?
Yeah, so there's a pretty simple mechanical rule for how we distribute capital between the funds or investments between the funds. If we're facing a team or a primary issuer, a venture fund has first dibs. If we are buying from another investor or on an exchange, hedge fund has first dibs. In practice, what that means is both funds end up with a lot of the same names, and in good sizes, the venture fund usually ends up getting more risk exposure at an earlier stage. But we have one investment team, one set of theses. Things we love should be in both funds. The point of the hedge fund is our best idea is liquid fund. So we buy things we love and we put them in there. And to the extent we find something that's more compelling that's earlier stage, we'll rotate out of our long-term hold from time to time. But I mean, that's kind of how we approach it. Tushar, you want to add anything?
Yeah, I just want to touch on the point of one investment team. I think this is really important because I mentioned this in the opening remarks too. I tell our investment team all the time, your job is not to go find good investments. Your job is to form theses. And what we really are truth seekers. Our job is to think about how the market will evolve, how the technology will evolve. And we just happen to monetize by investing. So what that means is if we form a thesis, then we'll go find the best way to expose the portfolio to that thesis. And if that happens to be something in the primary markets, it'll go venture fund first, though it may cross over. Or if it happens to be something in secondary markets, it'll go hedge fund first, but it could cross over. But we're not starting with that in mind. We are starting with the thesis in mind, and then we just think okay, how do we actually bet on this now? And I think that fundamental shift in how we think about it is really, really important.
So the last one before we switch over to the markets, I don't know the numbers. I haven't seen the spreadsheets. I don't know the numbers. I would imagine that you could probably retire at this point. Why are you still working so hard, and what's the culture like?
I'll start on this one, and Tushar can add to it. So there's different reasons people get into crypto, right? There's the crazy libertarians and the Bitcoiners, and there's the decentralization maximalist types and the public goods funding kind of borderline socialist types. And there's all kinds of weird, crazy people in crypto who look at it and see different ideals in it. I think the thing that stands out to me the most is the importance of sovereignty for people. And I think COVID has kind of really highlighted the importance of that. Today there's lots of bureaucrats and politicians trying to tell us how we should live our lives and where we should travel and all these things, and I find it very annoying, and I generally don't think they know what they're doing. And I think it's important to maintain sovereignty. What's amazing about crypto is it's our way to have sovereignty in the digital realm. The most simplistic form of that is digital money, which is just Bitcoin or ETH or Sol or whatever. But having digital data, self-sovereign data, even having a wireless network that's managed and owned by the people instead of by Verizon and AT&T, having a music system that's owned by the people, right? I think the more time I spend in the space, the more time that really resonates with me as what's important. And given our vantage point, we have the privilege of helping accelerate that, and so we try and do that through capital allocation.
Yeah, I would tie my answer back actually to the last question of, how do we think about investing? And really, I mentioned, we're a truth-seeking organization. We're not just looking for good investments, right? We are missionaries, not mercenaries. We're not actually doing it just for the returns ourselves. Honestly, after a certain amount of money, it doesn't matter anymore. What are you going to spend it on? You just can't consume it. So it becomes more about what is the impact you can have. And right now, I think the greatest impact that I can have or that we can have is by helping advance this technology. We want to create more freedom in the world. We see this software as the way to create more freedom in the world. We see this software as a way to create better coordination for human economic activity. And it's pushing the frontier. And sometimes you just see a mountain and you have to climb the mountain because it's there. Because what else are you going to do? Just sit at home until you die? I'm so addicted to crypto because it's the most insanely stimulating thing. It's an intellectual black hole. You can't stop thinking about it even if you try. And so I really think that I can't imagine myself doing anything else.
I'm just going to plug into the metaverse matrix style, and then I'm out.
Exactly. I'm there with you. So switching over to the markets, you mentioned some terms like maxis and crazies and mercenaries and all this. Do you think the future is going to be one chain, L1s and L2s, multi-chain? What does the future look like from the blockchain perspective?
I guess I'll start here. So I think the answer to this question depends on a function of your time horizon. In the immediate future, call it next 12 months, the answer is very obviously multi-chain, because a lot of people raise a lot of money, are doing a lot of stuff, and they're going to keep doing stuff until they run out of money, and they have pretty big bankrolls behind them. So minimum 12 to 24 month horizon is the world that should be getting more heterogeneous. I think the question is what happens between months 24 and 60, call it. That I think it's less obvious that you continue to get more heterogeneous, and I can make pretty good arguments as to why you revert back towards something that's more homogeneous. That doesn't necessarily mean one chain, but let's say instead of 6 or 8 or 10, it might be 2 or 3 major ones. That's probably my base case for where we are between 24 and 60 months from now. Beyond, call it 60 months from now, you can make an argument for more consolidation, but again, we'll see how the technologies evolve. I generally prefer homogeneity to heterogeneity in the tech stack, but I'd say I'm uncommon among my peers in that belief.
Yeah, there's a bit of disagreement there sometimes. We don't know yet, right? It's very hard to have a convicted view on this. My base case is that we end up with a duopoly, because I see blockchains as another level of operating system. Right, I talked earlier about mobile, because mobile was the last time we had a major new operating system and changed how we structure society. And I see a lot of reasons why operating systems end up in duopolies, because there's huge economies of scale in these types of platforms, right? And so there's a natural consolidating effect to this. But I also think there needs to be some choice, and there are. If you look at the history of operating systems, it ends up in having some nuanced choices between 2 different platforms. So you have some freedom to choose, but the economies of scale really prevent there from being many more platforms, because it just doesn't make sense for developers to be writing things for 10 different operating systems. It doesn't work. It doesn't scale very well. So my guess is a base case is a duopoly. Though this could end up more like TCP/IP, as a protocol, which is there is no competitor really to TCP/IP that matters at all, and so it's possible that it ends up more monopoly than duopoly. But I don't see a scenario where it's more than 2 chains. That seems incredibly unlikely.
So in a world where there are a couple of chains or 3 or 4 chains, how do you think about the chains working together? How do you think about bridges? How do we end up in a world where you don't have the green bubble, blue bubble scenario that we have with Android and iOS? What is the kind of future of interoperability of those chains?
Yeah, so one way to think about it is if you think back to the 90s, a lot of people were thinking about intranets instead of the internet, right? And everyone was going to have their own intranet, and then you could connect them together with these bridges. And so I think bridges are really important, intermediate technology. But they add another layer of trust assumptions and another layer of complexity for composability. It's just more friction. It makes it harder. Now, I think some of the bridges are really amazing technology, and they are going to help push crypto forward in terms of what we can build in the near term. But in the long term, I think it's just another layer that if we can not have that layer, everything will be more efficient. And just now, if you start an internet business, or if you're a company, maybe not an internet business, you don't even think about setting up your own intranet. No one does that. It's all public internet. Everyone connects to the same one place. And there's no more bridges between intranets, really, unless you're DoD or something, and you really need to have your own private network.
Whenever you use a bridge, at least in current blockchain systems, you add some latency, you break atomicity, you increase total gas consumption. In the current models, you can't get around any of those things. It's plausible in future models you can, although I'm skeptical. No one seems to be seriously talking about that today, but who knows what magic people will come up with in 2 or 3 years. Assuming the kind of current constraints stay on the system in terms of latency increase and breaking atomicity, it's going to be really interesting to see where do the divisions form in users, either regionally and capital pools in these systems. You don't fully break composability in these systems, but you definitely hamper it when you break atomicity. And so I don't think we fully understand the limits of like what needs to be exclusively in a single shard versus not. It certainly helps if everything is in one shard. It just makes it easy. But people will explore pushing those things into different places, and that boundary is still not very well understood.
So let's talk about some of the things that are being built on top of the L1s, the different applications in different sectors of crypto. How do you think about, and we'll go rapid fire, I'll give you kind of one by one, but we'll signal it here. DeFi, NFTs, metaverse, social tokens, community tokens, DAOs. How do you go from kind of thesis to investing in each one of those, and how do you allocate among them? DeFi.
I think you should take DeFi. I'll take some of the other stuff.
All right, yeah, that's quite a list. All right, so how do we think about theses in DeFi? Really, like one vision that we have for DeFi is DeFi becomes the global back end of the financial system, and you have local front ends that adhere to regulations, that do customer support, that someone calls if they forgot their password, et cetera, right? But it allows for those smaller financial institutions to plug in to the same global pool of liquidity that like a JP Morgan can plug into today. Right now, like JP Morgan can give you more complex products than your local, like credit union or something, because they have the ability to tap into different pools of liquidity that the smaller financial institutions like simply don't. And so by creating a global backend to the financial system, I think you create a lot more access and inclusion of these different front ends that allows many more people to participate in capital markets that historically have been unable to, or have been forced to participate in very, very narrow ways, which is like, you're allowed to buy like this list of index funds in your 401k and you can't do anything else because we simply don't have the infrastructure to support you.
Cool, so rapid fire, NFTs.
I'll wrap NFTs into metaverse more broadly. I think metaverse stuff is still very early. My general rule of thumb is if the pitch deck says the word metaverse in it, do not invest. It does not have anything to do with the metaverse if it's in the pitch deck. Most of them are games and are pretty simplistic. I do think the stuff that's metaverse relevant today is going to be the core backbone and infrastructure that makes these things possible. So things like Arweave, which hosts a lot of NFTs, things like Render, which I think will be used to render just the sheer number of digital objects we're going to need to have in these digital universes. So I think we're still at like the deep tech infrastructure layer for metaverse stuff, much like where Solana or Stark were or Ethereum were 3-4 years ago, 5 years ago. I think we're in that similar kind of stage for metaverse NFT stuff.
What about, I'm going to wrap these all together because I think you can make a choice between and among these things. Social tokens, community tokens, and DAOs.
All right, so I'll take social tokens. I think social tokens are going to redefine a lot of business models on the internet because so far, like one of the primary ways for creators and influencers to monetize has been advertising. And it's just like a terrible user experience to have these ads in there, right? Like you might be following an influencer on Instagram and then they have to shill some like product to you that like no one really like they don't want to sell you the product. You don't really want to buy the product, but it's the only way to support them, And I think social tokens enable this new dimension of interacting with your fans and your fans being able to sustain you, right? So it enables for people to get perks that they care about more, right? Like I don't care about buying whatever product from that influencer, but maybe what I care about is, I own enough social tokens that I can meet them. Or maybe I get access to some content that they put out that I get access to it first or some other perks. Or maybe this allows me to form a community of other people who also have similar levels of, like attention devoted to this influencer. And so I think that creator tokens or social tokens are going to redefine how these influencers and creators interact with their fans and is going to help make the whole user experience of the internet better. Because I think advertising is like one of the worst parts of the internet user experience.
I'll leave it at that. Do we have anything else, or are we going open Q&A or more rapid fire?
I think we have one last question. I think the people came here for the alpha. What is the soul of 2022?
What is the soul of 2022? It's probably still soul, honestly. It sounds funny, but like really these things compound at like really high rates for an extended period of time. Like, will it go, 200x in a year? Like probably not. That's a lot. That's very hard to do on a compounding basis. but they compound for extended periods of time. Otherwise, very, very excited about Helium. I think it's at a breakout moment. And very excited to see where 5G goes for Helium. I expect major developments on that next year. The IoT network has hit escape velocity, in my opinion, and I'm really excited to see usage tick up on Helium. So I would say those two are probably my top picks for Sol of 2022.